Hey, today on the final bar, we're going to talk about the market action today, how it connects to the long-term trends, particularly through the lens of market breadth. We're going to break down breadth characteristics of the current market, look at this week, previous week, how that relates to the long-term trend, what it should mean for you as a long-term investor. Also going to answer many of your questions from the final bar mailbag. Some of the questions about scanning, a couple of technical indicators, break down all of your curious questions about technical analysis. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close to look at today's price action connected to the long-term trends. It's always easy to get caught up in the short-term movements, caught up in today's trading, so let's do our best to sort of connect it to the big picture. Think about what these trends mean and how they're evolving. In particular, when we're thinking about breadth, which is one of the segments we're going to have today, I'm always wondering what the breadth tells us about the broad market conditions, right? So looking at a chart of the S&P is one thing, but looking at breadth is sort of that next level below the hood, where you get a sense of what's happening, to the average stock, right? All the individual names that compose the broader market environment. So we'll hope to answer some of those questions today. Also, speaking of answering questions, we will bring up some of your own questions from the Final Bar mailbag, answering some of the things that you've been looking for in terms of what you're interested in. In terms of what's coming up with the schedule, we have a lot of interesting things coming up. We have the YouTube live Q&A coming up this Thursday, the 13th. So make sure you sign up on our YouTube channel. You can hit subscribe, hit the notifications. You'll get an alert when we're on live. And so that's going to be actually a new way we're testing YouTube to try and make sure it's more interactive, engage with you guys real time, thinking of the charts. Also, we have Jim Smith, who's a GAN analyst that I'm very familiar with. He's coming up in the next week as well. So make sure you check out the StockCharts TV listings. We've got a lot of interesting guests coming up in the coming weeks. Let's move right on to the market recap. What I'd like to do is just think about today's trading connected to the long-term trends. We sold off quite a bit through the course of the trading day, and that was one of the biggest issues. Sort of started strong, but as the day went on, it sort of felt a little weaker and weaker, and all of a sudden the S&P finishes almost flat for the day. The Dow literally flat, 0% change from day to day. So a day that started out as a continuation to the upside sort of settled down to be, sort of sideways stagnant. What's interesting, though, is if you look below there at mid caps and small caps, were actually up fairly significantly. So the mid cap index ended up over 0.75% positive. Small cap, same thing. So it was a reversal of the story that we've seen for a number of weeks, if not a number of months, which is the domination of large and mega caps relative to small and mid caps that had struggled a little bit. Tables turned today with small and mid caps actually leading the way. In sector rotation, it was actually pretty interesting. Real estate, the #1 sector, followed by energy. Energy has been one of the weakest groups, as we know, for the longest period of time. So remember, this is a counter trend move for sure, but overall pretty interesting to see the rally in energy. Real estate #1, we've talked about that recently, and as I mentioned, I think yesterday we were interviewing a REIT expert down at the Money Show in Orlando. We had some really interesting comments about real estate investment trusts and the dividend component, how they relate to the other sectors. A lot of people are less familiar, but you have to be familiar with the fact that they keep finishing at the top of the return list. You want to be aware of it. Tech actually at the bottom of the list, followed by consumer staples. Those are the two sectors that were really materially weaker. So, a bit of a breather certainly for technology. This is certainly a digestion day, is what I tend to call, a sort of a pullback, a digestion of the previous gains, a nice run up, and then a chance to sort of take a pause. So the question now is going to be, what does that mean for the big picture? What does that mean for the future? So let's look at a daily chart of the S&P. You can see the gap up we had out of the open, but then we closed a little weaker. So short term, this certainly feels a bit weaker, right? Certainly not finishing in a position of strength, which is what I feel like I've heard myself say many times in the last couple of weeks, right? We finished toward the highs of the day. This is sort of the opposite, where we open higher and sort of trade lower into the close. So the question now is, this is happening just after this big bearish divergence or a non-confirmation with higher highs in the S&P, lower peaks in the RSI, and that's sort of what, we didn't really see like a big upside follow through that negated that divergence. So I think that's still in play. We have to sort of watch and see how that evolves in the coming days. Back to the member dashboard, I wanted to go down to look at global markets. So we had a number of markets that were actually up significantly stronger, and it's a lot of things tied to the commodity complex, so things like Brazil, Russia, and a lot of the Asian ETFs, so China as well, a lot of those up at the top. Looking at industries, however, there are some really interesting themes. So you have some materials groups that are up here. And again, I'd always caution you, I think a lot of people fall into the trap of looking at daily moves like this, seeing paper stocks as number one and thinking, oh, great, this is a nice move, 2.7% higher. What should we look at? But if you look at the chart, remember, this is quite the counter trend move, right? So let's look at this chart together very quickly. So you've had a group that's actually been down in a downtrend, right, for a number of weeks, sort of came off the 200-day, now below two downward sloping moving averages. Now we have this consistent pattern of lower peaks, lower valleys, or lower highs and lower lows. And even though the last 2 days have been relatively strong compared to other industries, remember that the highs keep getting lower. And until we establish a higher high, until we break above that last swing high from the first week in February, it's still telling you that, that it's favoring weakness over strength. So don't get too worried about this. What you do want to be worried about, what you want to pay attention to, is when things bubble to the top of these return lists over a series of sessions, right? Not just a one-hit wonder type of move, but a consistent appearance in the top, on the top list. So brewers, for example, seem interesting. If you look at the little preview chart, you can see this is in much more of an uptrend. It's a new high, a new closing high, new intraday high today. Specialty REITs also on the top of the list. Semiconductors, which I've always mentioned, is sort of a bellwether group. It's a group that you want to, in general, sort of be along with. So if semiconductors are doing well, the market overall is in pretty good shape. Now returning, trying to test sort of those long-term highs. On the bottom, we have some familiar suspects, things like in consumer staples, the tires group has actually been relatively weak. Coal has been consistently toward the bottom, but then you also have some other real estate groups. So real estate actually in a little of both. And I think it's interesting to note a bearish engulfing pattern on some of the REIT groups as well, and particularly the retail REITs and real estate services. You can see on the chart here the big up candle followed by a down candle. This is a bar chart, but you get the idea. A big up day followed by a big down day. A bearish engulfing pattern that occurs at a downward sloping 200-day moving average. I won't say that's a perfect trading system, but in general, that certainly says the likelihood of lower moves is pretty significant. And then I think the only other noteworthy one on here is software, internet, two groups that are actually one of the weaker groups today. Software is actually what we call a dark cloud cover, if I remember right. Am I right? I think that's right. Where basically you have a big up candle and then a lower candle that goes at least halfway through the previous bar. We have the CMT symposium coming up in a couple weeks, and I'll ask my CMT brethren to remind me of bearish candle patterns. Sorry for that little mental hiccup. So that is our market recap for today. And again, I think if there's anything to take away from today, it's sort of a day that settled down into a flat return for the S&P, but there are plenty of movements in terms of equity ETFs, also industry groups, and plenty of individual names that we don't have time to get into, but I'd encourage you to look at those and remember it is not just a stock market, it's a market of stocks, so there are plenty of opportunities for differentiating returns within there. Let's go to our next segment, which is called Banking on Breadth. As we talked about this show and talked about what we could do with it, we often came back to this idea of breadth. And as you know, if you've watched this show before, I'm often bringing up a breadth chart as one of the 3 and 3 or during our market recap, because for me, The chart of the S&P 500 tells you sort of the high-level idea of what's happening. But the way you technically answer why that's happening is to look below the level, look at things like sector rotation using the RRG charts, for example, looking at sentiment, looking at survey data and volatility, also looking at breadth, which is the way that you measure the strength of the overall market based on the individual stocks. I'm often asked, what's the difference between breadth and sentiment? So very quickly, sentiment would be, for me, anything that relates to, what people are thinking. So volatility is sort of a fear gauge. The VIX is something we often talk about as a fear gauge. Something like survey data, the AAII, the Investors Intelligence Surveys, anything market vein is another one. Anything that tells us, what people are saying or what they're feeling. Breadth is a measure of participation, and that's the key word here, right? So the couple ways you can think about it is the market is doing scenario A. What is the average stock doing? Are more stocks than not following the broad market? And what you get toward the end of a bullish phase, looking back at market history, is you actually get kind of an environment that you're seeing now, where the stock market itself, if you measure the broad indexes, going to higher highs. But the performance, the breadth of those of that index, the average movement of the individual companies is actually going down. So that tells you while the market is going higher, less and less companies are actually participating in that upward move. If you think back to the high in 2007, if you know your market history, if you were investing back in 2007, the market topped out in the first half of 2007. But things sort of drifted higher, and if you looked, a lot of stocks like Pepsi and others actually continued on to new highs in the second half of the year, even though the market, the average stock was already breaking below its previous swing lows. Some of the more conservative, large blue chip types of stocks continued higher. So that's kind of what we're looking at here. So let's go through a bunch of these breadth charts and talk about what the conclusions are for right now. So here we're looking at the S&P 500 for the last 5 years. We're looking at the percent of stocks in the New York Stock Exchange, and then for the S&P 500 and whether they're above or below their own 200-day moving averages. So right now we have about 65% of the New York Stock Exchange above their 200-day, about 76% of the S&P, and that's coming off of a little bit of a lower level. We were down to 60 to 70% for those two measures about a week ago. But with the bounce up in stocks, we've seen it come up a little bit. But overall, you can see this is down significantly from the first couple weeks of the year. Right at the beginning of January, this spiked up very, very high. So you had 85% of the S&P above their 200-day, which is an extreme high level. It had not been that high for well past this this chart further off to the left in market history. But that's happening while the S&P, the index, is actually going to higher highs. So it's almost like a bearish divergence with RSI. You have less companies participating in the upside. Now, you may ask, does that mean a market top, right? Is that a screaming bear signal? And the answer is, of course, yes and no. And I would say this is one of those things from my own experience. It's one of those things you would say it's called 10 of the last 2 corrections, right? It triggers a lot of sell signals. Sometimes you see the follow through and it actually plays out correctly. I'm looking for things like this that are similar in conditions to previous tops, and then I can start to look at other indications to see whether we get confirmation for that. So for me, price is number one. You'd want to look to see if the price itself actually breaks down, confirms this divergence. You can also look at it on a shorter term time frame. So here's the S&P, and the number of stocks, or the percent of stocks in the index above its 50-day moving average. Here you can see it's a little bit lower. It's around 64%, but again, well below the beginning of January. So any of these measures looking at moving average participation, right? Stocks above or below their moving average, certainly suggesting a little bit of weakness here and less participation on this most recent upswing. Some of these breadth measures on our platform, we don't trigger them until we are able to get all the closing data, process it, scrub it, and make sure that it's correct. So we're not going to see some of the breadth measures for today's trading. This is the price bar is as of today. At the bottom here, it's not quite updated for today. This is the stocks new highs and new lows for the last year on the New York Stock Exchange, and then also 52-week highs and lows for the S&P 500 at the bottom. What we can see here is there's actually this strange pattern where you actually have an increasing number of new highs and an increasing number of new lows. We don't have enough time to go in what's called the Hindenburg omen, but if you're not familiar with it, maybe in the next couple of days we'll have time to break it down. If you Google it, you'll find some information on it. It's basically a pattern, a bearish market pattern that uses the McClellan oscillator, new highs, new lows, moving average on the Dow, and some other random things, and this combination of factors factors suggests a potential for a market top. One of the inputs is an increase in the new highs and the new lows, sort of that indecision where you have stocks going both ways, and that's kind of what we're seeing here right now. But overall, very few stocks making a new 52-week low, which makes sense because we're at such elevated levels. This chart in particular we use a lot on the show for good reason, because it's looking at cumulative advanced decline lines on the S&P 500 as well as other cap tiers. So I'm looking at large caps to mid caps to small caps down the way, and I've color coded it green if it's positive, yellow if it's neutral, red if it's negative. And by my read, the further you get down the cap tiers, the weaker the breadth has been in the form of this. This is taking stocks that close up on the day, stocks that close down on the day, taking a cumulative measure of that number over a longer period of time. So it's a way of seeing when the market does one thing, are stocks actually following through? And you can see that same thing, right? The S&P advanced decline line has held up okay, but all the other advanced decline lines are making lower peaks, and that's sort of confirming what we saw at the moving average read a little earlier. Now, if you just look at the S&P 500, looking at some of the other measures, though, there are plenty of things that still remain fairly positive. So this is the cumulative advanced decline line on the broad New York Stock Exchange, taking a lot of different securities, breaking to new highs. This is the new highs minus new lows, looking at the difference between the two. That's remained fairly constructive, showing you that overall there have been stocks closing, making new highs versus new lows. Very few new lows is what's really propelling that line further. Up volume versus down volume, volume on up stocks versus down stocks, new highs recently. So a lot of these have remained sort of positive, but where the breadth once again confirms the negative side is when you look at the McClellan oscillator. This is sort of a version of the cumulative advanced decline line, but uses exponential moving averages to smooth it out a little bit. When this remains below zero, it tells you it's weaker relative to stronger, suggesting a little more caution. That's sort of where it's been. It's been sloping downwards a little bit, the moving average flattening out to down, and overall sort of remaining below zero. And the summation index, which accumulates those values over time, has broken that back down through its 50-day moving average. So that's a run through a lot of different breadth measures, trying to understand how they relate to the broad market. And again, to summarize, what I would say is a lot of breadth measures are holding up okay, but we're getting a lot of divergences, similar to what you see with the RSI on the daily chart, which just suggests potentially limited upside, weaker participation. It's very focused on a small number of mega cap names. We're going to take a quick commercial break. We're going to be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. As a reminder, please keep your questions and your feedback coming to us. The final bar at StockCharts.com is always the best way to get a hold of us. During the show, just shoot a question into the Q&A panel on the screen, and we'll get to them very, very soon. Also on Twitter at FinalBarSCTV. You can follow us there, get info on all of our guests, also ask us questions, and all of those we will bring together and answer them in the type of format like we do right now, which is answering the Final Bar Mailbag. So one of my favorite parts of the show, just to be able to hear from all of you and get some feedback on what we're doing, but answer some of your questions on the markets, on technical analysis, on StockCharts.com. Anything and everything is fair game, and I promise I will answer as many questions as we can. As usual, I have promised my wife to cut it down and limit it to 3 to 4 questions. Honey, I'm going to do the best I can. So question number 1 came from our chat room in the last couple days. What do you think of Tesla movements from last week until now? It's a really interesting question. I'm starting here with a chart of Tesla. This is looking at just the last couple months, looking at the last 3 months. And I did that just to show how different the market has been when you look at the chart of Tesla, right? So Tesla looked like this before, had a certain characteristic, had a certain trend, was certainly in a consistent uptrend coming off of the lows from last year, but overall sort of slow and steady relative to what's happened in the last couple weeks. So this line here at the bottom is the average true range for the last 14 days. So it's essentially showing you what the range is, what range you can expect from the stock. And the fact that this has spiked so much, again, it didn't look this crazy. This was actually looked, it had a lot more noise to it until you sort of changed the characteristics. So the fact that the average true range has spiked so much shows you what a different environment it is. It shows you the parabolic rise in the stock. RSI was overbought for an incredibly long period of time. So it became overbought back here in mid-December. It remained with an RSI above 70 all the way till about a week ago, which is insane. That is incredibly rare, and it shows you what a strong upside move we've had. We've often talked about something being extremely overbought when an RSI is above 80. The RSI here actually got above 90 the first weekend of the month here, but overall has remained in that overbought condition for a number of times. Consistently became extremely overbought, which told you all of the upside momentum. So what do I make of it right here? Well, I'm going to switch to a different chart. You know, if you've watched the show, I rarely bring up intraday charts because I want to think as much as possible about the long-term trends, and I want to stay oriented there. But when you think about the movement in Tesla and what it means relative to historical trends, you got to zoom into the activity a little bit. And I will tell you, after that big exponential rise, and then what I'd call a digestion move, where you sort of come back to earth a little bit, we're looking at a 30-minute chart here, by the way, looking at the last 4 weeks of trading. You can see that after we've come off the last couple days here, we've now sort of settled into an equilibrium. And the way that I'm showing that is using the Bollinger Bandwidth. So I'm not showing the Bollinger Bands. That's based on standard deviations around a moving average. But basically, the lower the bandwidth, the tighter the bands, the lower the volatility based on his methodology. And if you can see on the 30-minute chart, this Bollinger Bandwidth is the lowest it's been since before this big breakout. And John Bollinger's theory, generally speaking, is before a big move one way or the other, you have a lightening of volatility, a lessening of volatility, and I think that's the environment we're seeing here in the short term. So that is my long-winded way of saying I think we had a big spike. I think we're now digesting that. I would not be surprised if we see the momentum resolve in one way or another, and whichever way that momentum resolves, that's sort of the way that I would probably be assuming we'll see continued move in Tesla. So thanks for that question on the chart there. Second question, this came via email. You guys do great work. I will accept that, thank you. Looking at chart lists, have you considered being able to put chart lists into groups or folders or something like that? That's actually a really good idea. I love that thought. We'll talk about that as a management team, as a development team, see what we can do. What I found using StockCharts now for a number of years, but really using it heavily since I joined the team here last year, I've been using chart lists often. I use them every day, all the time. They're up on my screen most of the time. And I found, as you do, the more you use, the more they sort of proliferate. So my short answer is no, we can't do that. That's a great idea. We'll take a look at that, see what we can do. But I did want to give you some ideas about how you can manage them a little better. Number one, I would encourage you to put them in a meaningful order. So I use the Arthur Hill trick, which is putting numbers before your chart list. So if you do that, then you can reorder them as you want. And so I've often put the ones that I'm looking at a lot with a little exclamation point or something so that they're very, very top of my list. That's helpful to sort of bubble things up very easily to the top. The second thing, you can categorize your chart list. So if you just make a blank chart list with a title, this is a great way to sort of organize lists into different groups. And so I know if I'm looking at sectors and industries, all of my sector and industry chart lists are in the same place. And then I'm only looking through 6 or 7 lists as opposed to looking at a ton of them. The third thing I would say is, remember, now that we've added that symbol summary page, if you go here to your symbol summary, there's a brand new function that Grayson Rose was on the show yesterday sharing this new function. So if you missed it, check out that video on YouTube. But if you go to the bottom, it will actually show you which chart lists have that ticker in it. So if you remember, I have that chart list and it has this ETF, EWZ, which one was it? You can bring up the simple summary page and you can actually jump right to your chart lists that have that ticker. So hopefully that gives you some ways to manage the chart list a little bit. Thanks again for that suggestion. Again, please keep feedback like that coming. That's going to help us make the product a little bit better. The next question was related to screening. We interviewed JC Press. We showed that on the show about a week ago on Monday the 3rd. Really good conversation with him about his process. And he was talking about how institutional investors use 2 things primarily, relative strength and momentum. And I agree 100% with JC's point on that. And that has been my experience as well. So what do you do to screen for things like relative strength and momentum? We talked on a previous show about the percent relative function. That's a way that you can actually screen for stocks that are outperforming or underperforming a benchmark. In terms of momentum, I think what we show on here, this is on the sample scans page on our support pages. If you look for a screen for those keywords, you'll get to this point. And if you search for momentum scans, you'll get right to this point in the article. And these are the couple things that we've suggested, which I think are actually pretty decent. One is rate of change. So this text right here will allow you to look for stocks with an increasing slope in their rate of change, which is actually a pretty interesting one. It's looking back 5 days. It's doing a 12-day rate of change, and it's saying a slope above 10. That's not bad. This one is actually looking at MACD, and it's showing that the MACD is improving. So down here at the bottom, the histogram, today's is higher than yesterday's is higher than 2 days ago, 2 days higher than 3, and the text basically, if you just copy that right into the scanning engine, it's going to look for where the MACD histogram is increasing, which is also going to give you a similar thing. Your real question was how to refine that list, and I would tell you with anything like scanning, I could tell you exactly what I would put in, but I would want to look at the results, and actually it's a bit of an iterative process, right? You want to see, this might give you one result, at which point you want to make it a little less restrictive. It might give you 100 stocks, and you say that's way too many, and you want to make it a little more constrictive. So it's up to you to start with something, and I would say these two are really good places to start, and then refine it from there. Tweak the settings, tweak the universe you're looking at, and I bet you'll come up with a good list of stocks that are showing positive momentum. In general, positive momentum means the trend is up. So anything you can do to try to quantify that is where you want to start. So thanks for that question on screening for momentum. The final question related to the chart list. I often show these chart lists as part of my on my dashboard. These two right here, the global equity ETFs, and then looking at Dow Industries. How do I, how did I create this? Looking at the sector tickers and then the industry. The short answer is it took me a lot of time, and I spent time building this. You are more than welcome to go through and do that on your own. You are also more than welcome to just shoot me an email, thefinalbar@stockcharts.com. Tell me you want the ETF chart list or the Dow Industries chart list. The little number on here is going to help me remember exactly what you're asking me, and I'm happy to shoot it right to your login. You're more than welcome to copy it, tweak it, and do whatever you want. So the question was, how do you build it? I went through manually and typed sector tickers because I was trying to think of a great way to show this as part of my weekly and daily routines. You are more than welcome to take it. Just shoot me an email. That was our final bar mailbag for today. Thank you all so much for sending your questions in, and please keep them coming. We need to wrap the show by going to our 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these have not been on your radar yet, I hope they are from this moment on. Chart number 1 is looking at the dollar index, $USD. If you're looking intraday, this actually prints at the end of every trading day. So the UUP ETF is a great way to see short-term movements. So if you're looking for that, what's happening today, just use the UUP. If you're looking for long-term trends, $USD is the best way to show it on our platform. What I'm doing here, looking at the last year, is looking at this change in characteristics. And I think why this is interesting is over the last week, we've seen consistent higher closes in the dollar index. It's back above its most recent swing high, which was here from the end of November of last year, really changing from what had been a very negative chart, breaking down through the 200-day moving average, retesting it, and going lower through the lowest Fibonacci level. The RSI never got above 60. That's all very negative. That has all changed. We're back above the 200-day. We're back above the previous swing high. The RSI is actually overbought for the first time in quite a long time. So overall, I think the dollar is setting up very bullish relative to other currencies, which suggests, in general, the outperformance of U.S. stocks versus global stocks, all else being equal. So that's chart number 1. Chart number 2 is just looking at the relative performance of growth versus value. We've talked at times about a potential emergence of value as a theme. We talked a lot about this last fall as the value index started to outperform as this ratio went lower. Boy, that has completely reversed course. And whether you look at it this way, which is the growth versus value ETFs from Russell, you can also do a pure growth and pure value. They're telling you the same thing. It's sort of long and strong favoring growth. So that's telling you stick with U.S. stocks, stick with growth names until that ratio turns. It's telling you that theme has continued. The final one is looking at consumer discretionary versus consumer staples. This is one of my favorite ways to look at offense versus defense and where institutions are rotating within the consumer space. You're seeing a real divergence between the XLY and XLP at the top and the equal weighted versions of that at the bottom, and that has to do with the weighting. So something like Amazon has a huge weighting. Big mega cap names have a big weighting on these cap weighted ETFs like the XLY and the XLP. So we're threatening a new high. The ratio is actually pulled to a new high today. However, if you look at it on an equal weighted basis, it's still very much favoring consumer staples over discretionary. So what this tells me in my technician's head is that as a stock picker's market overall, there are opportunities in both sectors. But if I have to make a sector bet, I'm still thinking to lean more defensive because that's where the momentum has certainly been going. Ladies and gentlemen, that is our show for today. Thanks so much for joining us every weekday here on The Final Bar. You can get your questions to us. All of those questions from today came from you guys over the last couple days. Really appreciate your questions and your feedback. TheFinalBar@StockCharts.com is the way to get it to us. Put in a quick comment in the Q&A during the show here, or get to us on Twitter @FinalBarSCTV. We have our YouTube live Q&A coming up this Thursday, so do me a favor, go to our YouTube channel, sign up for notifications, which means when we go live this Thursday, you'll get an alert. You can come and join us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a good night.